Hey guys, thanks for tuning in at the kitchen table. I'm Matthew Goodrich, broker owner of Goodrich Real Estate. We're here with Wally Stevens, local mortgage banker. He's been a mortgage banker for over 40 years, him and his wife. So today we're going to talk about government insured mortgages. The U.S. government isn't a mortgage lender, but it does play a role in helping more Americans become homeowners. 3 government agencies back mortgages: the Federal Housing Administration, FHA loans, the USDA, which we won't talk about today, and the U.S. Department of Veteran Affairs, VA loans. So would you like to alleviate a little bit like that on that, Wally?
Well, we'll talk about FHA first. There's a lot to it, but let's just go to the basics.
Okay.
Typically, FHA mortgages are 3.5% down. They have a little bit more flexibility in the credit scoring. The interest rates in most cases are a little better than a conventional mortgage. And like I say, the underwriting guidelines have got some room in them that we don't have in conventional finance, conventional mortgages.
Okay, great. And so borrowers need a minimum FICO score of is it at 580?
Yeah, it goes down to 580. And again, as the credit score goes down, there's additional requirements. We refer to them internally as overlays, but basically it's additional requirements by the lenders to offset some of the risk involved in those low credit score mortgages.
I got you. And so if they have a little bit of a higher credit score, then they can do more financing with the FHA, correct?
That's correct.
Okay,
the rate
great.
usually is better, and we end up with a lot more flexibility in what we can do.
Okay, and then also FHA loans require 2 mortgage insurance premiums. One is paid up front and the other is paid annually for the life of the loan if you put less than 10% down, which can increase the overall cost of your mortgage, correct?
That's correct. Exactly what you said, yes.
Okay, great. Okay, so let's quickly dive into VA loans. VA loans provide flexible, low-interest mortgages for members of the U.S. military and their families. Talk a little bit about VA loans, Wally.
VA loans, again, and goes back to both of VA and FHA. The VA and FHA both offer 30 or less 15s. They both offer adjustable rate mortgages. And the VA loan is the one really good thing about that. It's 100% financing.
Okay.
Again, it has more flexibility in the underwriting guidelines than like the conventional mortgage. And it has one type of, it's not mortgage insurance, but it's called a funding fee.
Okay.
And if a veteran has any kind of disability at all, the VA waives that funding fee.
Okay, great. And VA loans, they don't require down payment, do they?
Zero down payment.
Okay,
Zero
great.
down payment.
Okay. So quickly, what's the pros of a government insured loan, whether it's a FHA or VA loan, Wally?
The biggest thing that we look at when we utilize those programs is the flexibility in the underwriting standards. FHA, typically when we start getting around 55% of their gross monthly earnings, which represents everything, it starts pushing back. It'll kick it out.
I
VA
got you.
runs off of what we call residuals. So they look to see if the family has enough money after their payment and their obligations to pay, electric and live.
Okay. So I got you. So sort of like if you don't qualify for a conventional loan, the FHA or the VA may be the way to go.
That's right.
And then
typically it's FHA conventional. Typically.
Oh, okay, I got you. And so credit requirements are a little more relaxed. They need a little less of a down payment, and they're open to repeat first-time buyers.
Yes, that's correct.
Okay, great. Okay, lastly, cons of the government insured loan. What are the cons to it?
Well, you touched on it briefly. The FHA mortgage has 2 mortgage insurances. So you have an upfront mortgage insurance premium that's 1.75% or whatever, the base amount that you're borrowing, and that gets added to, you can pay it in cash.
Okay.
It's added to the mortgage, 99.9.
Okay.
Then you have an annual, and as you indicated, if you don't put down 10%, that annual mortgage insurance is 0.85%, and it never goes away until the loan is paid off.
Okay, so there's a little bit more overall borrowing costs A little more
Yeah.
documentation depending on the loan type to prove eligibility.
That's correct.
Okay. So quickly, who should get a government insured loan? What type of person?
Well, again, it's we usually use the FHAs on a situation where we have a lower credit score. Perhaps they had some dings in their credit in the past, like I mentioned, bankruptcies, short sales, foreclosures. That's when we use that product.
Okay.
Again, as a mortgage banker, we look at it as what's the best product for the consumer. It doesn't affect us one way or the other when we do a mortgage.
I got
as far
you.
as on our end.
I
It's
got
just
you.
Where do they fit?
So sort of to wrap this up, government insured loans are ideal if you have a low cash savings or less than stellar credit and maybe can't qualify for a conventional loan. VA loans tend to offer the best terms and the most flexibility compared to other loan types for qualified buyers.
Yes, sir. That's correct.
Great. Well, you know what, Wally? Thank you. Thank you for joining me at the kitchen table. I'm Matthew Goodrich, broker owner of Goodrich Real Estate, God Family Business.